Hello, I'm Jason Kelly. Thank you for joining me today. I wanted to take a minute in this video to discuss how the stock market is actually a social system as a way to help understand why predicting it doesn't work. It's easy in the stock market to get caught up in what seem to be rational ways of looking at it, especially with the numbers and the charts and the authoritative looking figures on TV, who will say, for example, the price earnings ratio of the S&P 500 or IBM or the NASDAQ 100 has always been a certain level in the past, and now it's way above or way below that level, implying, or sometimes directly saying, that it's going to revert back to its mean. Which seems rational if you think that the stock market is assigned value by a computer that looks at what it should be. But that's not how it works, is it? It's people. Ultimately, it's people driving stock market prices. Keep this in mind, and it makes it very clear why it's impossible to predict in the short term. People's emotions and what makes them want to buy or sell stocks are driven by all kinds of inputs. Headlines in the news are the most obvious one, but there are other factors that from the economy, from society, that can affect the supply and demand of stocks, mostly the demand with people buying and selling, right? And people lose track of this, especially highly rational people, highly analytical people will lose track of this. I speak to a lot of engineers, for example, who are investors, and I'll say things like, this doesn't make any sense that the market's at a 22 PE. It's historically been down around 14 or 16, depending on which source they're looking at. And they'll say, it's got to get back to that, right? And assuming the prices will take it down. But the problem with that is prices won't take it down if people don't want to take it down. If something in the news, if something in society, if something in the zeitgeist of the moment makes people want to own stocks, they can own them from a PE of 22 all the way up to a PE of 28, all the way up to a PE of wherever they want to take it. And there's no rule that says they have to crash stock prices because the PE has gone too high, or the price to sales, or the price to whatever, any sort of rational seeming analysis of the stock market. The stock market is irrational, right? Because it's a social system made up of people and their emotions. Think of Amazon.com. Has it ever traded at a multiple, that is a price to its earnings, that has made sense? Not really. My entire lifetime as an investor has been spent looking at Amazon get more and more ridiculously expensive, with the company saying it's investing in the future, and rational, long-term, seasoned investors saying this can't go on. The company's losing money for 20 years, it can't go on, and yet it's been a fantastic investment. This doesn't mean I'm in favor of Amazon or I think the market is not overvalued. I'm indifferent to all of it. The point is just it cannot be predicted due to the emotional involvement of people. Don't fall for the charts. The charts can look so authoritative, so accurate, and when we put a precise number on things, for example, we wouldn't say the PE is 22. A pundit who wants to look very authoritative would say something like, the market PE right now is 21.78, and the extra 2 decimal places makes it look so accurate and so believable. The guy must know what he's talking about, and he probably does, but it doesn't matter, because if people want to buy a stock market at a PE of 21.78 and take it up to 29.78, they darn well can do that. It's human behavior. It was Benjamin Graham, the author of The Intelligent Investor, who famously said, in the short run, the market is a voting machine. In the long run, it's a weighing machine. Meaning that these emotions are in control in the short term, and in the long term, it's the cumulative success of business, the growing earnings over years and decades that assign value to stock prices. This is why there's no point predicting the short term. You can't. Because if you say you can, you're saying you can predict human emotion, and you're unable to do that, just like everybody else is unable to do that. You don't need forecasts for the long term, because guess what? Stocks are going up. And you can't forecast in the short term, so give up forecasting. And the reason you should is that the stock market is made up of people who are made up of emotions, which are manipulated by all types of inputs. The rational numbers be darned. Keep this in mind. I hope it helps you maintain a cool head when others are panicking out there. Kelly Letter subscribers, I will see you Sunday. If you're not a Kelly Letter subscriber, why don't you get on the list? I'd love to see you there. If you like this video, please give me a like on YouTube so others can find it. See you next time. Thanks for listening.